Hello, this is Victor Cuevas with Victor for Advice. I'm going to make this video as quick as possible. It's going to be a case study, and I think you're going to like it because this is going to be a case study about a businessman, a typical businessman. I'm going to call him John Smith. And he's come to me at a time in his life. He's 45 years old, and he wants to finally start saving for retirement. He's built his business. It's going well. He's got good cash flow. And we've done a financial review, and he's decided that he can commit $25,000 a year for the next 25 years until he's 70 years old. And then at age 71, he's going to start drawing income. Now, he may not want to retire at that time, but he wants the option of just pulling the plug, and at 71, he rides off into the sunset, and he gets a retirement income. Now, he's trying to figure out, is it better to do what an accountant is telling them to do, and that is a qualified plan like a 401k or an IRA or something like that, or a SEP IRA like for a business person, or a solo 401k, where all his contributions are going to be tax deductible, and he gets to save taxes now, and then the money grows tax deferred, and then at the end, when he retires, he can start drawing income. However, it's going to be 100% taxable. Or should he do something like I've suggested and consider a tax-free retirement program, a strategy that involves cash value life insurance? Now, I want you to refer to my other videos of why considering tax-free retirement is so incredibly important today, because of taxes and because of our runaway debt. We have no idea what taxes are going to be in the future. It's just smart to think about tax-free retirement. Also, not putting your money in the market. You don't have to put your money in the market to make great returns. And with the cash value life insurance plan, the one I'm going to show in this video, there's never any market risk. However, you earn great income based on stock market indexes. So go to those previous videos. I don't have time to explain it to them in detail now, but this is what I'm going to explain in this video. So let's go ahead. I'm going to show you both ways, in the market and cash value, and then I'll show you how it just makes sense to go with tax-free income. So let me get my glasses on so I can see what I'm doing. I'm using Allianz Insurance Company, which all my research and hundreds of illustrations, I've determined this is one of the best, if not the best, for tax-free income, low cost, great accumulation, lots of different indexes that we can use that can give you a great return historically. So you see John Smith is here, and I've got him in a preferred non-tobacco. He's in decent health. And I've set this program to, when we put in the money, in this scenario, we're going to use the minimum death benefit and the maximum amount of accumulation. We're not concerned so much about the death benefit. We're concerned about cash accumulation. And so, not to go into all this in detail, but we're showing here $25,000 a year for 25 years. And in year 26, you'll be 71, we start drawing. We don't put any more money into it. We want an income stream here. We want to use all loans. We want to use all 100% indexing loans. It doesn't make a lot of sense to some people, but those of you in the industry, you know what I'm talking about. We don't have no riders, and we're using all these that are different indexes that we're using. We're using these 3 different indexes right here. And then when I put all that together in the program, which I've already done before I started the video, I can go quick view. And I see my spreadsheet here. And I see here that I have $25,000 every year going in for 25 years. And in year 26, I can begin drawing a tax-free income of $153,152 a year based on all these parameters, $25,000 a year, the way I've designed this policy, and the indexing that we're using. Initially, the death benefit is $607,000 here. If you were to go to someone else that didn't know how to do this, he would try to give you the highest death benefit as possible, not caring about the cash, to increase his commission income. And this 607 would be way, way high up into the seven figures. But we've run this down as low as possible. And you see here, we put in $25,000, and you have a cash accumulation of $22,000. Well, you know, if you put in $25,000 in a cash value policy and you have $22,000 the first year cash accumulation, that's a very, very well designed insurance policy. Cash value is including the surrender charge. That's a thing with Index Universal Life as opposed to whole life, that you have a surrender charge here. So it's going to be a while of 13 years before the cash value matches the accumulation, but you still have good money available to you even with this. Say in year 5 you're over 6 figures, and you can borrow against, so the business owner can use this cash value to borrow against for anything he wants and wants to pay it back, being an honest banker, we call it in this business. So we get down to year 25, and we have $1.5 million, $1,556,492 in cash accumulation, net the fees. Net the fees. We have this column here, all the fees that have been taken out of this policy, and I'm going to compare that with putting the money in the market with a fee-based financial advisor, like I used to be, a fiduciary. You can go with somebody that's just going to, like an Edward Jones guy, who puts you in mutual funds, and the cost structure is going to be similar. So that's this spreadsheet here. Let's take you to putting the money in the market. I just went to bankrate.com. I put in the investment calculator. We have 25-year accumulation period. We're not starting with any money. We're going to show a 7% rate of return. Now, in the illustration with the insurance company I just showed you, we have a 6.73% maximum rate of return. Even though the indexes I'm using are returning over 8% a year average, the insurance company and other rules in the industry would only allow me to illustrate 6.73. And that's based on going back 66 years and taking every 25-year period during that time and averaging them out. So it's a whole calculation we go through. But bottom line, we're using a 6.73 interest rate return over that period of time, average, using compounding interest. Now, going over here with the stock market, a 7% return is a good return in the stock market after fees. After fees. Now, as a fiduciary, I used to charge 1.5% on my accounts. Once an account gets around $1 million, it can drop to 1%. But that money goes to, financial advisors do not manage money. They move that money over to a third party, certified financial consultant. They do all the day-to-day managing and buying and trading, and those fees are undetermined. But they usually come out to about 1%. So you're looking at 2.5%, 2% on the low end, could be 3-4% on some accounts I've seen. So I'm just going on. I'll show you 2.5% where that would come in later. But in this case here, rate of return, 7% after all fees. And you see that at the end of 25 years, you have 1.6 million, 1,691,912. So it is slightly more than what we saw over here of 1.5. Now, here's a difference. we can draw out $153,000. That's over 9% of the accumulated value. Over 9% of the accumulated value. When you're over here, you're at 1.6. There isn't a financial advisor anywhere worth his salt that will recommend a client draw any more than 4% out of that account. Why is that? Because the stock market goes up and down, and what happens if when you start drawing income, your account that year goes down 20%. Well, you did have 1.6 million. Now you have a lot less because you've just dropped 20% and you want to start taking income out. So if you took out 4% of 1.6 and then the market goes down 20%, what are you going to do next year? Are you going to take the same amount you took out? So that is the problem with having your money in the market. When it comes to time to drawing income, you're still going to have to keep it in the market, a more in the market than not. Because if you don't, if you put it in a money market account making a 1.5%, you're going to draw down your money quickly. So you have to keep it partially in the market, if not 60 or 70% in the market during retirement, and you're still paying out those fees while you're having that money managed, and you still have to trust some advisor over there to make sure that they've got it with the right people. It's a crapshoot in retirement. So it's a risk that you take in retirement. I wouldn't recommend anybody to take that risk. But if you're at 1.1691, 912, and you take 4%, that's $67,000. So you're paying this financial advisor, and he's going to say, John, you'll be able to take, you've got 1.6 million, you'll be able to take $67,000 out, 676. Now you got to take taxes out. So let's say state and federal together, it's 20%, minus 20%. Now you're taking home $54,141. Now think about it. You have faithfully saved $25,000 a year for 25 years. You've got $1.6 million. You're technically a millionaire, although you owe a third of that minimum, 30 to 40% to Uncle Sam. So now you're only going to take home $54,000 a year. Now, I know most of you listening to this video, if you have $1.6 million in a retirement account, you're thinking, man, I'm going to retire well. I'm going to be pulling out $100-something a year. No, you're not. You'll run out of money in 10 or 15 years. And suppose you live another 30 years in retirement, 25 years. You can't take that risk. When the market does a 2008 on you, goes down 40%, your money a little bit more conservatively managed goes down 28%. What is that going to do to your retirement? And typically it takes 4 years to recover. I wouldn't take that chance. So yeah, there you are taking $54,000 a year after taxes. So I'm over here with my tax-free strategy, and you're taking $153,000. Now, I want you to look at this carefully. I want you to listen to this carefully. All you business owners, self-employed people, or people out there that are working, making a decent income, but you have no retirement account offered to you. Even if you're putting money in a 401k and they give you a little match or no match, you want to consider this instead. In this scenario, I just showed you $25,000 a year for 25 years. John's taking out $54,000 after taxes. Here, $153,000. That's a $100,000 difference in income in retirement. And you're looking at this and going, Victor, how is that possible? Well, it's very simple. If you have the $1.6 million and you have a stock market account with a financial advisor, one of these Edward Jones guy, whoever like that is out there, you're drawing that. If you take the 60-something thousand out, you're drawing down the account from that 1.6 million. You're drawing it down. If during that year the stock market takes a 15% dive, 12 months later, are you going to draw out that same 60-something thousand dollars a year to net 54? Maybe you won't. Maybe you're afraid. Maybe you say, maybe I'll cut myself back $10,000 this year. You have to be careful, but you're drawing down the account. In this scenario, you've got the 1,556,000, but when you take this 153, we don't take it off of this. We don't draw this account down. You see, what happens is that an insurance company is going to lend you $153,000. It's going to give you a loan for that. Loans are tax-free. It's like a reverse mortgage. And you won't, not only do you not have to pay it back, you don't even have to pay interest on it. The loan, the insurance company will lend you $153,000 every year, and interest on the loan will accrue, but you'll never have to pay it back. And how can the insurance company do this? Because they keep your money 100% fully invested, not in the market, but tied to an index. So you can't ever lose money. Remember, when we're using indexing within cash value policy, your cash value can only increase. It can never go down due to anything that's happening in the market. So if the index, and with indexing in these accounts, you can get anywhere from 0 up to 20-something% return on your money. So when you go 25 years and you never have a negative year, you're either going to have a goose egg or you're going to have some kind of indexing growth. And you compare that to having your money in the market where you're going to have those dips and you're going to have to crawl out of that hole and it's going to go up again and up again. Then you're going to have another dip. You take 2 steps forward and you take one step back, or 3 steps forward and 1 step back. And that 1 step back is usually a pretty severe step back. So you can see how indexing is a very reliable way to grow your money and never have it at risk. The only thing that comes out of your cash value in an insurance policy are the fees that come out. And those are going to come out every single year. Just like any other account you would have with a financial advisor or an Edward Jones guy, or even if you did it on your own with some mutual fund company, there's still fees always coming out of the account. So because the way you get paid with a life insurance policy, never touching your nest egg, the money is loaned to you. This nest egg, this is the cash value here, can continue to grow and grow and grow. And you can always take this money out, because one of these days, let's suppose you live to a ripe old age of 100. Okay? You've been taking out $153,000 every year since you were 71 years old, tax-free, and you die, and you still leave over here $797,000 plus tax-free to your heirs. This is what your account really has in it, $11 million. So most of that is going to pay off all the income you've been taking, and there's still $797,000 goes tax-free to your heirs. Now, here's the other very important thing that you absolutely need to know, all of you business owners and self-employed people that are listening to this and others. Something very important, and that's the fee structure. Okay? Now, if we go back here, you're at 1,691,912. Okay? And you have it with a financial advisor. You have all these talking heads on TV, Clark Howard's and Dave Ramsey's. And if Dave Ramsey wants to just to put it in mutual funds, forget about it. Or he will refer you to, a certified financial advisor. Clark Howard in Atlanta. Oh, he used to have one of his best friends was a CFA guy, certified financial advisor. He'd always say, work with a guy that only takes a fee. Okay, fine. You've got $1.6 million and you're working with one of these guys. I used to have that license. I used to be a fiduciary. I charged a fee, and you're working with one of these guys. I don't do the market anymore. I'm completely out of that. Sorry, it's a racket in my opinion. But 1.6 million times 2.5% total in fees, you're giving up $42,000. $42,000 to manage that account. So you cough up $42,000 that year, and the market goes down 10-15%, and you lose that too. Now, it's going to recover you. You'll get it if you stay in it. But the thing is that the fee has come out and the market has dropped. Now you're in the worst of a hole. And that $42,000, what were you taking out? You were taking out $60-something thousand in this scenario before taxes, and this additional $42,000 in fees. So a total of over $100,000 came out of your account for you to net $54,000. Are you following me? Now, I come over here. I've got 1.5 million, and what are my total fees? $6,683. $6,600 or $42,000. It's like you're getting ripped off over there, right? And guess what? Your advisor cannot guarantee you not one thing. The only thing he can guarantee you is that he's taking his fee every year. He's got to make a living. But can he guarantee you any growth? No. Can he guarantee you won't lose money? No. He can't guarantee you anything. But with a tax-free retirement income, I can guarantee you that you will not lose money due to anything that happens in the market. The only money that's coming out of your account is the fees. Got me? So now what's good thing is once you stop contributing, the fees go down because there's always going to be a premium charge on this for a lot of different reasons. Insurance companies got expenses. They got taxes to pay to the states and all that and federal. So, there's always going to be a premium fee. So look at here. Now you start taking income. Now this is important when you start taking income because you want your money well managed during the withdrawal period. Because you want your money to grow as much as possible while you're taking your money out. And if your financial advisor puts it with somebody that messes things up and your account drops 20% while you're drawing income, that puts you in a bad spot. But when you're using indexing, you know that's never going to happen to you. But look at this. I'm at 1.6 million. You've taken 153,000, but your account has grown to $1.6 million. And let's suppose you took money out and you had a great stock market year and it went up to $1.6 million after you had taken your money out, after the financial advisor has taken his fee out, after the third-party money manager took their fee out. You're still at $1.6 million. Well, 1,672,878 times 2.5%, you'd be paying your advisor to almost $42,000. And what are you paying for your policy? $2,619. Well, what percentage of that is? Let's look at that. 2,619 divided by 1,672,878. That's a 15th of a percent. Did you get that? You've got $1.6 million working for you through indexing, growth tied to the market, but not in the market, so you can't lose anything. You're guaranteed not to lose a dime. The only thing that's going to come out is this 2619. And it's 0.15%, not 2.5%, not 2%, not 1.5%, not 3 or 4% like it could be. 0.15%, 0.15. Folks, listen to me. That is less than a Vanguard index fund, or about the same, or a cheap, super cheap index fund. Your retirement money is sitting here growing well, with the opportunity to grow anywhere from 0 to almost 30% and anything in between in any given year. And you're at 0.15%. Even if you had a goose egg that year and didn't earn a dime, you're still only going to lose out of that account the $2,600, as opposed to $40-something thousand. Plus, your account went negative. So, as you can see, I mean, look, folks, I just want you, I just did this as a way of showing you, so you can just use your common sense. Use your common sense. Well, how do I want to save for retirement? That's the big question. Do I want to go conventional wisdom, says put it all in the stock market and have someone manage it? Or try manage it by myself? I'll tell you what, maybe 1% of people out there even want to fool with managing their own money. I know I've been in this business for 25 years. And I had a client that had a doctor's degree in finance, and she worked with companies on their spreadsheets and their profit structure and all that stuff, and she didn't know what a mutual fund was. She heard about them, but she didn't know how to work. She didn't want to manage any of her own money. So believe me, folks, there's people out there, they don't want to fool with that. Okay? So they want to give it to somebody, and they're going to pay for that, and that's fine. People have to get paid for their expertise. But if you're going to pay to save for retirement, which way do you want to pay? Do you want to put it on the market, or do you want to put it in a tax-free retirement plan using an index universal life to maximize? You can see right now that your income is going to be through the roof, and you know why that happens that way, as opposed to taking only 4% of this. Now you know why with the cash value life insurance policy using index universal life, you can take so much of a higher income than if you leave it in the market. And you can see why that income is sustainable, because the fees are negligible and all your money stays in the market, never touched, growing and growing and growing and growing year after year, which allows the insurance company to continue to lend you that high income every year, tax-free. And then when you get to retire, then when you pass on, there's a tax-free death benefit, substantial, that goes on to your heirs, as opposed with a 401k. Let's suppose you go all the way to your 100, and let's suppose it's done well, and it's still $800,000 in this account. It gets fully taxed to your heirs. So again, don't worry about Mr. Business Owner or self-employed. Don't worry about having to pay taxes on what you contribute to a retirement account while you're still working. Don't worry about that. Your accountant is going to tell you, hey, we got to open this solo 401k. We got to open this simplified employee pension plan. You're going to get a tax break. I'll save you on taxes. All the money you contribute is going to be tax exempt. Don't go for that, because in retirement, you'll pay way, way more, many, many, many times more taxes in retirement if you do it that way. And when you pass that on after your death, it gets taxed to your heirs, the residual amounts left. It doesn't make sense to save for retirement and take a tax break and then have everything fully taxed in retirement. Makes no sense at all. The numbers I've just showed you don't bear that out. So if this has been helpful, if you want to meet with me and let us do a review together, see what you can commit, and let me run the numbers for you, I'll be happy to do that. I think you'll be pleasantly surprised. At least consider it. Do a comparison before you make your final decision. This is Victor Cuevas. Victor for advice. God bless. I hope to be talking to you soon. Take care.